Today we are breaking down a seismic shift in the Indian derivatives market. Seriously, a massive tax hike has just rewritten the rules for traders. And over the next few minutes, we're going to give you the playbook you need to navigate this new reality. Okay, let's just dive right in with one single, incredibly important number, 91%. According to SEBI, that's how many individual traders in the futures and options segment actually lost money last year. Now, this isn't just some random statistic. It's the entire reason we're talking about this today. You see, the government's recent tax hike, it wasn't really about collecting more revenue. Think of it as a deliberate intervention, a behavioral tax specifically designed to hit the brakes on a high-risk, speculative frenzy that was causing so many retail investors to lose money. So, to really get a handle on the new rules of the game, we first have to understand how we even got here. The story of this tax is really the story of a changing philosophy in the market. The Securities Transactions Tax, or STT, has had a pretty wild ride. It all started back in 2004, and it was just a simple way to collect tax right at the source. But, over 2 decades, its purpose has shifted, and shifted dramatically. By 2026, it's morphed from just a collection tool into this powerful instrument meant to actually influence how you and I trade. So what even is STT? The easiest way to think about it is like a toll you pay for using the market highway. It's a tax on the value of your transaction, not your profit. So whether you make a killing on a trade or you lose your shirt, you still pay the STT. It's this, ruthless application that makes it so incredibly impactful. And the market's reaction to this hike? Well, it was just as ruthless. The announcement sent this immediate, brutal shockwave through the system, basically recalibrating the entire market in one single, unprecedented trading session. So picture this. It's a Sunday, February 1st. It was only the second time since independence that the markets were even open on a Sunday. And right in the middle of this special live budget day session, the government drops the news about the new tax structure. The reaction wasn't just fast, it was instantaneous. The BSE Sensex just plummeted by over 2,000 points. In just that one session, more than 6 lakh crore rupees in investor wealth, it just vanished. This wasn't a dip, you guys. This was a fundamental repricing of risk all across Wall Street. And this chart, wow, it tells you exactly who felt the most pain. Just look at the stocks of the exchanges and brokerages. Companies whose entire business model depends on lots and lots of trading, they took the biggest hit by far. The market was sending a crystal clear signal. The age of high-frequency, super low-cost trading was over. Okay, let's get into the new math of it all and see exactly how this is going to change your P&L, because this is where the abstract policy stuff directly hits your trading account. I mean, these changes are staggering. The STT on selling equity futures wasn't just increased, it was hiked by a massive 150%. For option sellers, the cost jumped by a very painful 50%. These are not minor tweaks, folks. These are absolute game changers. Let's put that in real money terms. Before this, selling one Nifty futures lot would have cost you about 322 rupees in STT. Today, that exact same transaction costs you over 800 rupees. The cost just to execute the sell side of your futures trade has more than doubled. And for an active day trader, this isn't just a few hundred rupees here and there. We are talking about up to 1 lakh rupees a month in additional costs. And that's before you've even made a single rupee of profit. This just fundamentally blows up the risk-reward ratio for any short-term strategy. And hey, it's not just retail traders who are feeling the squeeze here. This massive cost increase is causing a tectonic shift in how the smart money, the big institutional players, are operating. So, faced with higher taxes at home, what is institutional capital doing? Well, it's doing what it does best. It's finding a more efficient route. And that route leads directly to Gift City, India's international financial hub, which for them operates like a tax-neutral haven with zero STT. And the result? A massive, massive surge in activity in offshore contracts like the Gift Nifty. We're now seeing monthly turnover there that's exceeding $102 billion. The big players are voting with their feet, and they're walking straight towards a lower tax environment. So, this brings us to the most crucial point. With costs going up and institutions shifting their strategies, how does a retail trader like you adapt and survive? You need a new playbook, and that's exactly what we're going to lay out for you right now. Okay, first things first, you have to be more selective. This means focusing only on high conviction trades, where the potential reward really outweighs these new higher costs. Make every single trade count. Second, you have to reduce your trading frequency. Those high churn, scalping strategies are just way too expensive now, and they're a surefire way to let taxes just eat up your capital. Third, and this is a critical tax shield, treat your trading like a business. This lets you claim STT as a deductible expense against your income, which can make a huge difference. And finally, think about the long game. The tax on delivery-based investing hasn't changed at all, making it a more attractive option than ever for building wealth. As one market analysis perfectly put it, the game has changed. The days of scalping for just a few ticks of profit, they're effectively over. The higher break-even point forces you to have better discipline and to focus on quality over quantity. So it's essential now to figure out where you fit in. If you're an active trader, declaring your F&O activity as a business income and filing with an ITR3 is no longer just some option, it's a vital shield. This is what lets you deduct STT as a business expense, and that can significantly soften the blow of these rising costs. And remember, all of this isn't happening in a vacuum. This huge regulatory shift is coming at a time of pretty significant global instability. With the US-Iran conflict pushing oil past $106 a barrel and the rupee weakening, your margin for error as a trader is just getting squeezed from all sides. And that really leads us to the final and I think provocative thought I want to leave you with. The market has been fundamentally rewired. The costs are higher, the risks are greater, and the old ways of trading might just not work anymore. So the question you really need to ask yourself is this: is my strategy designed for a market that doesn't exist anymore? Because to survive in this new world, it absolutely must evolve.